Something big just happened in the gold market, and most people missed it. While traders and investors were focused on a recent dip in gold prices, official data from China told a very different story. According to Chinese customs figures released on July 24th, gold imports for the month of June reached approximately 173 tons. That number is not just large. It is the highest monthly total China has recorded since March of 2024. It also marks the third month in a row that imports have climbed higher. To understand why this matters, it helps to look at what usually happens when prices fall. Many casual buyers pull back. They wait. They hesitate, hoping for an even lower price before they commit. But large-scale buyers in China did the opposite. They saw the price dip as an opportunity, not a warning sign, and they moved quickly. Earlier reports had shown Chinese imports sitting somewhere between 151 and 163 tons back in May. Then June arrived, and the number jumped even higher, despite softer international prices. Analysts at Bloomberg, along with several Chinese business outlets, confirmed that this surge happened right after global gold prices took a noticeable step back. In other words, the timing was not random, it looked deliberate. For the first half of 2026, China's total gold imports have been running well above where they were at this point last year. In some earlier months, imports were up more than 70% compared to the same period the year before. That is a striking shift, and it reinforces something that has been true for a long time. China remains the largest physical gold market in the world. So why does this matter to someone watching from outside China? Because when the world's biggest buyer of physical gold moves in a big way, the effects tend to ripple outward. A purchase of this size does not stay contained within one country's borders. It touches the entire global gold market, influencing supply, demand, and eventually price direction. There are a few clear reasons behind this surge. The first is straightforward: price. When international gold prices pulled back, it created a buying window. Add to that a stronger Chinese currency, and imports suddenly became more attractive on a cost basis. It was, in simple terms, a moment where the numbers lined up in favor of buyers. The second reason involves everyday demand. In China, physical gold holds a special place in daily life. Families buy gold jewelry for celebrations. Investors buy bars for savings. Everyday consumers view gold not as a luxury, but as a practical way to protect their wealth. Banks and importers have been working to meet this steady demand, using available quotas to bring more physical gold into the country. The third reason sits with the country's central bank. The People's Bank of China added another 15 tons of gold to its official reserves in June alone. This was not a one-time move. It was part of a buying streak that has now lasted 20 months in a row. That steady accumulation has pushed China's official reserves to roughly 2,246 tons, worth an estimated $304 billion. For comparison, the United States holds far more gold in its official reserves at about 8,133 tons, worth well over $1 trillion. But raw numbers only tell part of the story. When population size is factored in, China's gold holdings look different relative to its people. And some analysts believe the country's true reserves may be even larger than what has been officially reported. Whatever the exact number turns out to be, one thing is becoming difficult to ignore. China has been steadily reducing its reliance on the US dollar, choosing instead to build up gold as a strategic asset. At the same time, U.S. Treasury holdings by foreign nations have dropped to levels not seen since 2008, two trends moving in opposite directions at the exact same time. To really understand what is happening with China's gold imports, it helps to zoom out and look at the bigger picture. This is not a single, isolated purchase. It is part of a much longer pattern that has been building for years, and June's numbers are simply the latest chapter in that story. Let's start with the official channel that confirmed this news. China's Customs Authority is the government body responsible for tracking and reporting import and export data across all sectors, including precious metals. When this agency released its figures on July 24th, it gave the clearest picture yet of just how much physical gold entered the country during June. And the number, 173 in tons, was not a guess or an estimate from outside analysts. It came directly from official government records. This matters because gold imports are not something companies or banks can simply hide or manipulate on a large scale. Physical gold has to cross borders, pass through customs checkpoints, and get logged in official trade data. That makes this kind of report one of the more reliable ways to measure real demand, rather than relying only on market sentiment or price charts. Now, let's look at what is currently happening on two separate levels: the retail level and the central bank level. On the retail side, demand inside China remains extremely strong. Everyday citizens continue to buy gold jewelry, coins, and bars, whether for personal savings, gifts, or important family occasions like weddings. Banks and licensed importers are responsible for meeting this demand, and they do so by using import quotas set by the government. When those quotas are used at a high rate, as they have been recently, it shows that real, on-the-ground demand is pushing imports higher, not just speculation from large financial institutions. On the central bank side, the numbers tell an equally important story. The People's Bank of China, which is the country's central banking authority, added 15 tons of gold to its official reserves during the same month of June. This was not a random addition. It continued a streak of monthly gold purchases that has now stretched across 20 consecutive months. Over time, small monthly additions like this add up. Today, China's official gold reserves stand at approximately 2,346 tons, valued at around $304 billion. To put that in context, the United States holds significantly more gold in its reserves, roughly 8,133 tons, worth well over $1 trillion. On paper, that is a large gap. But several analysts have pointed out that official numbers may not tell the full story. Some believe China's central bank could be holding more gold than it publicly reports, using it as a quiet strategic reserve rather than something to advertise. Whether or not that is true remains uncertain, and no outside party can confirm it with full certainty. What can be confirmed, however, is the broader direction of policy. China has been actively working to reduce its dependence on the US dollar as a reserve currency. Gold has become a central part of that strategy. At the same time, foreign holdings of U.S. Treasury bonds have fallen to levels not seen since 2008, according to available data. These two trends, a rising interest in gold and a declining interest in U.S. debt instruments, appear to be moving together, even if they are not officially linked by any single policy announcement. This is where credible sources become especially important. Financial outlets like Bloomberg, along with official customs and central bank data, have all pointed in the same direction. Chinese demand for physical gold is not slowing down. If anything, the current details suggest it is accelerating, driven by a mix of everyday consumer habits and deliberate central bank strategy. When a country the size of China increases its gold buying at this pace, the effects rarely stay contained within its own borders. This section looks at what these consequences actually mean for global markets, for everyday investors, and for the broader financial system. The most immediate consequence involves price support. Strong, sustained demand from the world's largest physical gold market tends to act like a floor underneath prices. Even when international gold prices dip, as they did before this latest surge in imports, buying from China and other major markets can help prevent deeper, more damaging price drops. Analysts have pointed out that this kind of physical demand behaves very differently from paper trading or speculative positions. Physical gold, once purchased and moved into reserves or private hands, tends to stay there. It is not easily sold off in a panic the way a financial contract might be. This creates an interesting contrast between East and West. In many Western markets, gold-related investment often flows through exchange-traded funds and other paper-based products. These flows can be more sensitive to short-term price swings, sometimes moving in and out quickly based on investor sentiment. China's approach looks different. The demand described here is largely physical, meaning actual bars, coins, and jewelry changing hands, or being added to central bank vaults. Some analysts describe this as a more patient, long-term style of buying, compared to the sometimes flatter or more hesitant flows seen in Western markets recently. For everyday investors, this distinction carries real weight. When physical demand from a major market like China remains strong, it can provide a kind of underlying support for gold prices, even during periods of short-term volatility. That does not mean prices only move in one direction. Markets remain unpredictable, and short-term swings are still possible. But a steady, structural source of demand from the East has been described by analysts as one of the key factors supporting gold's performance in recent years. There are broader economic implications as well. China's move away from heavy reliance on the US dollar, paired with its growing gold reserves, reflects a wider global trend. Central banks around the world have been net buyers of gold since 2022, often citing reasons such as protection against currency risk, inflation, and geopolitical uncertainty. China's actions stand out simply because of the scale involved. As the world's second largest economy, its choices carry weight that smaller nations' decisions may not. At the same time, it's worth presenting a balanced view. Some observers question how transparent China's reported reserve figures really are. There have been suggestions, though unconfirmed, that actual holdings could differ from what is officially disclosed. Others point out that a stronger Chinese currency, rather than any dramatic policy shift, may be a simpler explanation for a portion of the recent import increase. These differing perspectives matter, because they remind viewers that no single explanation fully captures a story this complex. For those already holding gold, whether in physical form or through gold mining investments, this trend offers a form of fundamental support. It does not guarantee prices will rise sharply or immediately. Short-term ups and downs are still part of the picture, but the consistent buying pattern from both everyday Chinese consumers and the country's central bank suggests that demand is not fading, even after recent price corrections. It is also worth noting how gold tends to behave compared to silver during different price cycles. When prices fall, gold historically tends to lose less value than silver. When prices rise, silver has often outperformed gold in percentage terms, though gold typically still moves upward as well. This relationship helps explain why many long-term holders view gold less as a way to generate quick profits and more as a stable store of value over time. Taken together, these consequences point to a larger shift already underway. Physical demand is rising, central banks are diversifying, and the balance between East and West continues to tilt in a new direction, one that may shape how gold behaves in the months ahead. So, where does this leave things going forward, and what should someone watching this actually take away from it all? Looking ahead, a few key questions remain open. Will China continue buying at this pace, or was June simply an unusually strong month driven by a temporary price dip? Some analysts believe the current streak of increases, now 3 months running, suggests something more structural than a short-term reaction. Others caution that monthly import figures can be uneven, and a slower month could follow just as easily as another strong one. Only time and future customs reports will settle that question. Another point worth watching closely is the People's Bank of China's ongoing buying streak. 20 consecutive months of reserve additions is a significant run. If that pattern continues into the second half of the year, it would reinforce the idea that this is a long-term strategy rather than a short-term response to market conditions. If the streak breaks, that in itself would be worth noting, since it might signal a shift in policy or priorities. There's also the broader question of transparency. As mentioned earlier, some observers have raised doubts about whether China's official gold reserve figures tell the complete story. Whether the country holds more gold than it publicly reports may never be fully confirmed. But the topic is likely to keep coming up as global attention on central bank gold buying continues to grow. For viewers who hold gold or who are considering adding it to a portfolio, this story offers a few practical takeaways. First, physical demand from major markets like China has historically provided a form of underlying support for prices, even during periods of short-term weakness. Second, central bank buying, both from China and other nations, has remained strong since 2022, suggesting this is not an isolated trend limited to one country. Third, gold has traditionally served less as a tool for fast profits and more as a stable way to preserve wealth over long periods of time. None of this should be taken as financial advice. Markets remain unpredictable, and short-term price movements can still surprise even experienced analysts. But understanding the forces at play, strong physical demand, steady central bank accumulation, and a broader shift away from dollar dependence gives viewers a clearer picture of why gold has been behaving the way it has. So here is a question worth thinking about. Is China preparing for something bigger on the horizon, perhaps a larger shift in global monetary policy? Or is this simply a case of a major buyer taking advantage of a price dip, the same way any smart buyer might? There's no single correct answer, and reasonable people can view this differently based on the same set of facts. Viewers are encouraged to share their own thoughts in the comments below. Does this level of buying change how you view gold as part of a long-term strategy? Or do you see it as one data point among many, worth watching but not overreacting to? As the story continues to develop, future customs reports and central bank disclosures will offer more clues. Anyone interested in staying informed should keep an eye on official releases rather than relying solely on speculation or headlines. That is where the real answers will eventually come from. In the end, this is a story about patience and strategy. Physical gold does not move quickly, and neither does the kind of long-term positioning being described here. It builds slowly, month after month, purchase after purchase. And for those paying close attention, June's numbers offered one more piece of a much larger puzzle, one that continues to unfold in real time. Thank you for spending this time with Currency Matrix. Until the next story, stay informed, stay grounded, and keep watching the signals that matter.